Joining us live now is Ajay Patil, the CFO at Cummins India. Good morning, Mr. Patil. Thanks so much for joining us live right here on the market. My first question to you is, and as someone who's got such a large footprint also when it comes into the energy landscape, via the generators and the power generation, etc. This is a time when everything is about going green. We're talking a day right after the new green hydrogen policy had also been unveiled. So first up, how is Cummins India, can I say, pivoting towards this theme?
Hi, good morning to all of you. I think it's a very valid and a pertinent question given the broader intent of the government to be net zero by 2070. Obviously, when you look at our journey from now till then, there'll be multiple different ways in which the goals will be accomplished. To begin with, by itself, the emission standards which are applicable to stationary applications like gensets or off-highway applications or industrial applications that we support, they themselves will evolve and become stringent as we go forward. As an example, the CPCB 4 plus norms will be applicable sometime from July 2023 onwards. So that by itself will help in terms of reducing the extent of emissions. Looking at some of these newer technologies like hydrogen and fuel cell, obviously from a Cummins standpoint, we have a new division globally called New Power, which principally focuses on these technologies. And therefore, as we look at it, where we stand today, obviously there is a fair amount of interest from some of our customers to look for these solutions. And we are actively engaged with some of the customers to really put in place what I would call initially as a demonstrator units to establish the technology, establish the operating environment in which it can function, and then look at ways in which it can expand and gain scale for a much broader and deeper application in the economy.
When you came out with the last earnings set, which was received well by the market, the company had highlighted that despite the high order board, revenue was suboptimal by 10 to 15%. If I could build on this point more, your order book had been appreciated in the past. Like I said, you were being seen as one of the stocks to also invest in to play with the larger capex theme that we're seeing in India Inc. So what exactly did you mean by this?
See, currently what we meant by that is today we have a robust demand in terms of the order backlog that we are carrying. Supply chain constraints is what we were indicating when we said that we couldn't fulfill the demand for the quarter. And the supply chain constraints is something which we have been grappling with for the last almost close to 12 to 18 months or more. And more specifically, when it comes to semiconductors or electronic components, the constraints, go a notch higher. So that was the, pointer that we had when we were saying that we could have done more simply because of supply chain constraint. We couldn't fulfill the demand for the quarter. While in that itself, one looks at it and one can look at the other side of the coin and say that, okay, we walk into the current quarter with a backlog at an even higher level than what we had in the previous quarter.
Now, Mr. Patil, Nikunj Dalmi also joining in. As you pivot from being a traditional energy solution provider to a new energy solution provider, will all the new incubation be done in the listed entity or will it be in the subsidiary?
Certainly, it's a good question, Nikunj. The businesses or the portfolio which is there in the listed entity will continue. As an example, if there are end markets or customers which are serviced by the listed entity, the newer technologies will go through the listed entity for those applications. As an example, when it comes to power generation, DG sets, railways, mining, those are construction equipment. Those are the segments which are served from this entity. And we will introduce newer technologies at appropriate time in the future when these segments are ready to receive those.
Upfront R&D cost, which any company will have to spend, because you are going to be changing your generation in terms of service and in terms of technology, who will bear the R&D cost?
So the R&D cost typically has two dimensions. One is, of course, the availability of technology which we have internally from the parent company. So therefore, what we have been doing thus far, we will continue the similar model where we'll access to that technology through a standard technology transfer agreements. And from a development cost perspective, the entity, there would be a dual sharing of costs in the sense that the technology which is already developed globally, we will access that through a tech fee arrangement. If there is something which we need to invest locally from a supply chain perspective, from a supplier development perspective, or from a testing capability perspective, now we will invest it locally.
So what would be that turning point when the orbits will change for Cummins India? When I say change of orbit, the old business will be less and the new business will be more. You are in a business where the diesel generation business is a business which is a contracting business. A, availability of power has increased. B, there are fuel efficiency norms which have kicked in. So the diesel generation business, which has been your mainstay business, is a contracting business, and you would pad it up by adding new business lines. That's what we understand. So what would be the turning point?
I would slightly bring in a newer perspective to say that it's not a contracting business, because as you look at it, diesel generating set, the usage certainly has reduced as a consequence of greater availability of power, greater reliability of the power availability. So no doubt the genset usage has come down, but the need for a genset as a standby power, a diesel genset as a standby power will continue. And therefore you would have seen our numbers for the prior quarters. That domestic business is growing at a quite a decent pace. That's number one. Number two, when you look at any critical infrastructure, be it a hospital or a commercial real estate or a data center, a need for a standby power will remain. The usage, as I'm repeating myself, will possibly go down with the availability of power, but the need for the backup power will remain. And therefore, from a sustenance of demand perspective, a standby power solution will continue to be part of any critical infrastructure. Number two, you asked a question as to when is the orbit changing. The orbit changing is a function of what happens in terms of the breakthroughs that you get from an application perspective, or there is a step change in the emissions. Now, for a stationary application like a diesel generating set, a step change will occur next year when the CPCB 4+ norms will be introduced in India. And these are not just incremental emission norms. I think the government is making a step change with respect to emission standards. As an example, critical emissions like the NOx levels or the particulates, the improvement over current is going to be in the range of about 70 to 90% from what it is today. So we are not talking something which is growing incrementally. So when you try to address these kind of a step changes in emissions, you are looking at a very different level of engine technologies to ensure that those emission standards are fulfilled. And that is where I think we believe that we have the solutions, we have the technology, we have the product range to address those emissions in a far more robust manner, and both with the letter and the spirit of the law to meet those emission standards.
Sure. But Ajay, as you go about pursuing new energy transition projects, I just wanted to understand whether or not the margin levers are in place, because, clearly supply chain challenges had marred industries across the board.
No, certainly. I mean, I'll answer your question in two parts. So the first part is, of course, near term tactically, we are exposed to high commodity inflation, which we have been addressing through a combination of actions. So on one side, we have a very matured internal, cost optimization programs, which has been running for years in a very disciplined manner. And number two, obviously, we have taken some actions on the pricing side to mitigate the impact. Was that fully enough to mitigate the entire commodity inflation? The answer is no, simply because there is a lag effect that we have to deal with. And that's the reason, if you would have seen our material margin or a gross margin, we have a 100 basis point impact on that when you see from a year to date 9 months perspective. Having said, the other aspect which we have done is to look at all our fixed and discretionary costs such that we manage that in a very prudent manner. and also drive a very productive leverage as the volumes are ramped up. And as a consequence, when you look at our PBIT margins, those have expanded 60 basis points compared to FY 19-20. So while on one hand, we certainly have a commodity inflation, but the other levers that we have managed very effectively meant that we are able to expand the margin even compared to 19-20. Now, going forward, how does this play out? I mean, clearly, to take on from the previous question that was asked, I think when you look at some of the newer products, the scale of those products, the pace at which they get adopted, I think is an important aspect in order for us to have a very good cost position for the newer technologies. A bit early because some of these technologies are just about being spoken, and we are in the very early stages of introducing those technologies in the market.
Interesting. Ajay, great to have you on board today. Thank you so much for taking the time out.
Thank you. Pleasure.